Last week, the Federal Reserve had their final FOMC meeting for 2023. It was announced during the meeting that they will pause rate once again as expected for the month of December. However, Jerome Powell dropped a bombshell message indicating that the Federal Reserve might start cutting rates as early as next year. This is a complete 180 from all of the previous FOMC meetings where the message had been loud and clear that they're not considering cutting rates. But what does this mean to the mortgage rates? How will this impact the housing market and the equity market? Where will interest rates settle in year 2024? In this video, we're going to go over how much the Federal Reserve is expected to cut interest rate in 2024. How will that impact the mortgage rate and the housing market so you can make the best home buying decision, and how everything will impact the stock market. If you enjoy content like this where I do research and take a deep dive into the housing market, the latest information on everything that's on the market, be sure to like this video and subscribe to the channel. I really appreciate it. So now let's dive into point number 1. How much is the Federal Reserve expected to cut rates in 2024? First, we're going to take a look at the Federal Reserve scatter plot. This is what the Federal Reserve projected to cut interest rate. Then we're going to take a look at what the market, what the traders, the investors are actually expecting. And a lot of times, those two can be very different. And sometimes the traders, the market, they are more accurate at predicting how the economy will be, how the market will behave for the upcoming year. And the Federal Reserve does not really have a great track record at predicting what the interest rate will be, even though they are the one controlling the rate. But we'll get into that later. So now let's take a look at the Fed scatter plot. This comes at every single FOMC meeting where they update their projections for the next year, for the future. So this is FOMC's new dot plot. This basically displays what each FOMC participant projects or predicts the rates will be by the end of next year. So on this new plot that came from the December meeting, it shows that majority of the FOMC participants expect at least one rate cut in the year of 2024. Most of them project that there will be at least 3 interest rate cuts by the end of the year. So right now we're sitting at 5.25 to 5.5. Usually when there's a cut, you will cut a quarter or 25 basis points, 0.25%. So by the end of year 2024, it is projected to have a 4.5 interest rate, or 4.5 to 4.75 interest rate. That's at least what the FOMC is expecting. We're looking at the Fed fund rate in the 3% to 4% range, mostly ranging from the 3.25 to 3.5% range. As you can see, the longer term target of Federal Reserve's interest rate plan is to keep interest rate around 2%. And it's super interesting right here because the long-term inflation target by the Federal Reserve is also around 2%. So the interest rate is just slightly above the long-term targeted inflation rate. Now, the reason to try to keep interest rate relatively low but not near zero is that if you have a high interest rate environment, the cost of borrowing increases, the ability for the United States government to issue debt and pay back the debt becomes more and more difficult. There's more deficit every single year. So that's why the Federal Reserve tried to keep interest rate at a 2.5% range. But at the same time, they don't want to keep it at zero, because when you keep it at zero, Federal Reserve usually use that to stimulate the economy. In case there is any sort of economic downturn, they can lower the interest rate to 1% to 0.5% in order to increase borrowing and keep economic growth. So that's the two mandates of a Federal Reserve, which is economic stability and maximum employment. But we have to keep in mind the Federal Reserve isn't always right. In fact, they're actually very bad at predicting how well or how they see the future in terms of interest rate. For example, in December 2021, they projected that there will be maybe 3 rate hikes that brings the 0% interest rate at that time to around 0.75 to 1%. And during that time, the Federal Reserve basically said, oh, inflation is transitory. We don't have to think about inflation. There are no indicators that the inflation is here or is going to impact the US economy. Well, it could if you print trillions of dollars, and it's kind of ridiculous or kind of funny to think that they expect that there won't be any sort of growing concern of inflation during that time period. All this is to say, by the end of the year 2022, the projected interest rate was 0.75 to 1%. We actually ended the rate at around 4.25 to 4.5%. That goes to tell you kind of how unreliable the Fed projections are in terms of these dot plots. But so this could mean there could be more rate hikes in the future, but more likely than not, there might be more rate decreases or rate cuts in the upcoming year in 2024. So now let's take a look at the market, what the traders or the investors are expecting the Federal Reserve will actually do. And a lot of times the market is often more right than wrong. And in order to know what the traders and the investors are thinking, we can take a look at the Fed Watch chart. And from them, they expect that there will actually be 6 rate cuts in the year 2024. That's 3 more than the Federal Reserve expect them to make. At the same time, they'll lower the interest rate around 3.5% by the end of year 2024. So this could indicate that the market expect that there is somewhat of a deflationary, recessionary economic status going on by the end of the year 2024, and the Federal Reserve had to react more aggressively in terms of rate cuts in order to keep maximum employment and stable inflation. So now that we're on the same page about what the Federal Reserve expect themselves to do and what the market expect the Federal Reserve to do, and we have an understanding where the interest rate will be by the end of the year 2024, let's take a look and let's discuss how that will impact the mortgage rate, and more importantly, how that will impact the home prices in different markets. So you can make the best decision about whether or not now is a good time for you to buy your home. So I do want to mention that I am a real estate agent here in Austin, Texas. So I'll also be talking about what I've been seeing with my clients on the market here in Austin. And hopefully that can translate a little bit into the markets in your area. So we have to keep this number in mind, which is 1.5 to 2%. And we'll just take the average 1.8%. That is the magic number we're going to be looking at. So 1.8% is typically the spread between the 10-year interest rate or 10-year yield to the mortgage rate. If the 10-year yield is at around 4%, the mortgage rate is expected to be around 5.5% to 6%. But we'll just add 1.8, which becomes 5.8%. That is the expected mortgage rate in that instance. Now, I do also want to mention that the interest rate, the Fed fund rate, and the 10-year treasury yield, even though they have a positive correlation, it does not go one-to-one. But for simplicity's sake, we're just going to use the Fed fund rate as the 10-year yield. So in this case, if we use the Federal Reserve projection of that will end the year 2024 with 4.5% interest rate, then we're looking at mortgage rates sitting around 6.3%. And if we want to use what the market is actually projecting, the traders, the investor, what they're projecting, which is the 3.5 or 3.75% in Fed fund rate, we're looking at around a 5.55% for mortgage rate by the end of the year in 2024. So now today you can get a 30-year conventional loan if you have great credit at around 6.675%. That is what the lender gave me, my lender gave me last week. I'm assuming it will probably drop even more by the end of this week. So now let's bring all of those into context. How does that impact you as a home buyer in terms of if you buy a home today? So we're going to use some concrete example using the number here from Austin, Texas, where I am a real estate agent in. So if you're looking at a $450,000 home, which is the medium home price here in Austin, if you're using a 6.3%, your monthly principal plus interest will be around $2,200. But if you have a mortgage rate at around 5.55%, that is what the market is projecting the end of year mortgage rate will be, then you're actually looking at a principal plus interest payment of $2,000. So that's around $200 per month in savings if you buy a $450,000 home with 20% down. And because I work as a real estate agent here in Austin, Texas, what I've been seeing in the marketplace is that good quality homes that are in good neighborhoods and good school districts are actually getting multiple offers, and people are using and leveraging these lower interest rate opportunities to get into those homes. So what I expect is that those homes will have multiple offers, while homes that are not as move-in ready will see less opportunity and less competitions. But if you're a qualified buyer, if you're a quality qualified buyer with high credit score and save more than 20% in your down payment, and you want to get into a market because you want to get into a good neighborhood with a good school district, now is probably the best time, because we're sitting in this environment here, at least here in Austin, we have a higher inventory level where the sellers are willing to work with the buyer, where the buyers, most of them are unaware of the mortgage opportunities. So if you seize this opportunity and actually go negotiate hard against the seller and get a good offer with a good mortgage rate to get into a home that's in a great neighborhood, that's in a great area, then you're pretty much set in terms of getting the best deal on the market today. So if you're interested in buying your next home or looking to buy your next home here in Austin, Texas, be sure to reach out to me using the number in the description box below. Let's set up a time and talk about what kind of homes you're looking at, what kind of homes you're looking for, and how we can help you get into your next home here in Austin. And now finally, we'll talk about how the whole interest rate environment is going to affect the equity market, the stock market. And I know that it's super exciting to see the NASDAQ, to see the SP 500 rally this past week. I personally am happy to see my portfolio go up in value. I'm personally glad to see some of the beat down stocks that I owned actually gain in value. But what I foresee, let's back it up real quick and understand why interest rate is such an important factor in terms of the stock values or the equity market. It's because investors, when they're making investment decisions, they always have one thing to consider. A lot of financial models uses this principle or uses this factor as the way they calculate whether or not to make an investment, and that is the risk-free rate, the risk-free investment. And in this case, typically people use is the 10-year yield. So with a higher Fed fund rate, it means that the 10-year yield will be higher, and you have a guaranteed return from the US government that gave you, I think at the time, about 4.5% guaranteed. So why would people take a risk in the stock market where loss is possible, where the risk adjusted return didn't really make sense at that moment in time? But now, today, because the Federal Reserve is projected to lower interest rate, the 10-year yield now today is sitting around 3.8% instead of the 4.5% that we were talking about before. So now the risk reward ratio for the equity market becomes a lot more attractive compared to just buying everything in bonds. So that's why we saw the rally in the SP 500, we saw the rally in the NASDAQ, in the stock market, and people are getting a little handsy in terms of putting their money to work in the equity market. And we're looking at a lot of money sitting on the sideline and just dying to get in. And I don't blame them. This past year has been very tough. People didn't buy homes, people didn't buy stocks, everything just basically at a standstill. But now there is some pressure being let off by the Federal Reserve. So people are looking to get into the assets, to get into the equity market, get into the housing market. I can see some rally coming on. But now the best opportunity, I think, in the stock market, if assuming that the Federal Reserve has stopped hiking rates and that we're actually going to start cutting rates in 2024, according to their projection, the best opportunities are in the small cap and the mid cap, where they usually are more impacted or most impacted by the interest rate, because they need to borrow money, they want to invest in the business, they want to grow as fast as possible, and those is where the opportunity is if the interest rates start going down. Then you can look at the technology stock, who are very interest rate sensitive. But yeah, that's a quick overview of how the interest rate is going to affect the equity market. It's such good news all over that inflation is being kept down and the Federal Reserve starting to look at cutting interest rate. But we do want to keep in mind that they're just projecting. They still have to see whether inflation ticks up for any other reasons. We do see some potential dangers. For example, the Red Sea crisis that's going through right now on the news. You can go take a look at them. And that might affect trades. And if it affects trades, that might increase cost of goods sold and cost of goods produced. And that ticks up core inflation. And the Federal Reserve had to keep the interest rate higher for longer. We don't want that to happen. But fingers crossed, and hopefully everything gets resolved soon. If you enjoy content like this, please remember to like this video, subscribe to the channel. And until then, I'll see you next time.